Thank you for the invitation to participate in the opening session of this year's Financial Street Forum. I'm honored to join in this session. Asia has become an increasingly central pillar of the global financial system. The region continues to account for more than half of global growth. While uncertainties have weighed on external demand and prompted some firms to delay investment, domestic conditions remain broadly resilient. Inflation pressures are generally subdued, giving several jurisdictions more leeway for monetary policy support than in other parts of the world. On the financial side, Asian markets have deepened considerably. Local currency bond and equity markets have expanded in scale and liquidity, and international investors have become increasingly active across the region. While financial systems remain largely bank-based, non-bank financial institutions have grown rapidly over the past decade. China reflects these wider regional trends. Its financial markets have become deeper and more liquid, supported by measures such as Bond Connect, CIBM Direct, and more recently Swap Connect, which have broadened market functioning and access, particularly by international investors. Episodes of volatility show how global shocks can spill into Asia, and given the region's scale and integration, developments in Asia can also spill outward. Asia's rising weight and integration have taken place against the backdrop of broader structural changes in the global financial system, to which I will turn next. As we documented in the most recent BIS annual economic report, two major structural changes have reshaped the global financial system since the global financial crisis. The first is the notable shift in the locus of financial intermediation from lending to private sector borrowers to financing governments in the form of sovereign bonds. The second major structural change relates to the expanding role of non-bank financial institutions. More concretely, global portfolio managers have taken center stage from banks as the main intermediaries in the financial system. The shifts in global financial intermediation activity towards NBFIs has increased the likelihood that financial instability could originate or be amplified by liquidity stresses. Liquidity in sovereign bond markets increasingly relies on open-ended mutual funds, hedge funds, and other asset managers. These entities often face significant liquidity mismatches, rely on short-term funding backed by government securities as collateral, are either frequently highly leveraged or exhibit leverage-like behavior, and as a result, their liquidity provision is less stable and more likely to evaporate during periods of market stress. Hedge funds, in particular, have increasingly become a significant source of procyclical liquidity, especially in government bond markets in major advanced economies, such as the US, UK, Euro area, and Canada. These investors actively pursue relative value trading strategies that seek to exploit small price differences between related financial instruments. To boost the returns on these small price differences, they heavily leverage their positions. One method often used is to pledge government securities as collateral in the repo market to borrow more cash with which to purchase additional government securities. This practice has further evolved in recent years, with investors borrowing amounts equal to or higher than the market value of the collateral provided, that is, without any discount or haircut, protecting the cash lender from market risk. In turn, that means that the borrower can obtain more leverage, leaving the overall market exposed to dislocations if haircuts are increased even slightly, leading to forced selling. Hedge funds' relative value strategies are highly vulnerable to adverse shocks in funding, cash, or derivative markets, as evidenced by some recent episodes. During the market turmoil of March 2020, for instance, margin calls in Treasury future markets triggered fire sales, resulting in destabilizing deleveraging spirals. More recently, a more orderly unwinding of relative value trades, this time tied to interest rate swap markets, where investors have bet on a narrowing spreads due to potential deregulation, seems to have contributed to the heightened volatility observed in Treasury markets in early April 2025. NBFIs have also significantly expanded their role in cross-border financial transactions, mainly through portfolio investment in bonds. Many rely on short-term dollar funding and hedging markets through repos and foreign exchange swaps to finance positions and manage currency exposures. Notably, non-US pension funds and insurers hold substantial US assets hedged with short maturity FX derivatives that are continuously rollover. By end 2024, dollar borrowing through FX swaps, forwards and currency swaps accounted for 90% of the $111 trillion in these instruments globally outstanding. While FX swaps facilitate funding and hedging of large cross-border positions, they also expose NBFIs to significant short-term rollover risks and funding squeezes. Importantly, when an FX swap is not rollover, the dollar borrowing NBFI has to come up with the cash dollars to close out the position. And while risk and vulnerabilities have migrated to the NBFI sector, the immediate linkages between banks and non-banks have expanded the way stress in the NBFI sector could spill over to the banking sector. That is why regulatory frameworks have to apply similar stringency to financial intermediaries posing similar risks to financial stability, regardless of legal form or business model. A holistic approach or congruent regulation would ensure that even if traditional banking activities migrate to the NBFI sector, they would remain subject to similar regulation, in turn reducing the potential for dangerous build-ups of systemic risk. Examples could include requiring minimum haircuts in all securities financing transactions and appropriately calibrated margin requirements even in transactions that are not centrally cleared. These changes could improve the functioning and stability of bond markets in stress events and reduce the risk of liquidity spirals. Such a holistic approach to regulation would ensure that regulatory adjustments are made with careful consideration of systemic consequences, avoiding the unintended effect of merely diluting existing safeguards. In addition to strengthening financial regulation, ensuring sustainable fiscal trajectory is also critical for addressing the challenges posed by the post-global financial crisis structural changes in the global financial system, and in particular, the rising risk in sovereign bond markets associated with the growing presence of internationally active NBFIs.